Good morning, good afternoon, good evening, wherever this finds you. We are wishing you a happy new year and welcome to the 47th Emerging Growth Conference. I'll be your host today, Anna Berry. So just a few notes. Today we're running until about 3:30 Eastern Time. And remember that all of our conferences are uploaded to the Emerging Growth Conference YouTube channel. So check out our past conferences there. Please subscribe, youtube.com/Emerging Growth Conference. Now, during each company's presentation today, you can submit questions through our webcast module, and we will attempt to address as many of these as possible at the end of the presentation. Now, remember, when we switch to the next company, you're going to see a black screen for a moment. That's just us moving over. Don't go anywhere. But if you do experience downtime, refresh your browser. Everything usually works once you do that. Our platform does work best on Google Chrome. So if you're watching from an Apple device, you have to hit the play button to start the session. One last note. After today's event, you'll be redirected to the registration page for our next conference in 2 weeks. So stay on or come back to reserve your spot early. All right, let's get this conference started. Introducing Flotek Industries, Inc. It trades on the New York Stock Exchange under the symbol FTK. And while creating solutions to reduce the environmental impact of energy on air, water, land, and people, Flotek is a technology-driven, specialty green chemistry and data company helping customers across industrial, commercial, and consumer markets improve their environmental, social, and governance performance. Please welcome the COO, Ryan Ezell. Welcome, Ryan. Good morning to you.
Good morning. I'm really excited to be here today.
Yeah, we look forward to the presentation. The floor is yours, and call me back when you're ready for some questions.
All right, thank you. So, it's an honor to be here speaking to everyone today on behalf of what I consider to be a really exciting organization, and going to talk a little bit about our future. We want to keep this presentation short and impactful, and it's a very exciting story for 2023 when you look at an investment opportunity. It consists of what I would consider to be 5 major points, and that one, Flotek has evolved into a business that can survive a full cycle in this energy industry that we typically see in that type of behavior. Number 2, it's in the midst of a rapid growth phase, and we're seeing significant market share improvements for us, as well as substantial growth from 2021 through 22 and what we're expecting in 23 and 24. We're also transitioning to positive cash flow in our operations in 2023, maintaining a very strong balance sheet with minimal to no debt. And we're doing this growth with a lot of capital discipline. What you see in a lot of operations in the energy industry today is focused on that capital discipline. And we consider ourselves to be up at the forefront of that, at doing this growth with a very capital-light focus. When you look at Flotek as a whole, we're definitely a rapidly growing green oil field chemistry business that, we also have acquired and moved into the data analytics as well. And we do believe that this creates a significant amount of synergy in operations as we bring the understanding of real-time data into our chemistry applications. And we're based in Houston, Texas. We have operations that include North America, Latin America, the Middle East, and North Africa, and over 15 countries as of right now. When you look at our employee base, we operate with over 155 employees, and we've been a public company for well over a decade. Looking at our growth in Q4, we reported publicly that we had grown over 55% for sequential revenue on the quarter. And to put this in perspective, that's more revenue than we did in the entire year in 2021. And we do expect that to continue to grow in what we see in Q4 and that type of growth pattern and where we're going to be in 2022. Our growth stems from 3 primary areas. The first is that we signed a revolutionary take-or-pay contract with ProFrac, which is a major market-leading oil field service company that provides a lot of services in the stimulation or hydraulic fracturing part of the business. And we're currently in a substantial ramp up for that business, which I'm happy to say is on schedule and delivering the number of fleets and how when we presented in terms of what's out there in the public markets and growing. And we now are exceeding over 20 fleets in that business and moving on our way to 30. Second, we continue to gain market share in our transactional business, which was the core energy chemistry business before we signed that revolutionary ProFrac contract. And this is composed of many customers driven by our ability to maximize the ultimate recovery of hydrocarbons from an asset. This portfolio in terms of the transactional business is bolstered by intellectual property, where we have over 170 patents that are directed at improving how much actually hydrocarbons you can get from any reservoir. And when you take this into consideration, on equal footing, the same spin, getting a 20 or 30% improvement of the hydrocarbon definitely improves the return on invested capital for that asset production. And finally, we look at our data analytics business, which is something we're extremely excited about and has continued to gain traction. This near infrared monitoring capability that JP3 has posted 138% sequential revenue growth quarter on quarter. We're seeing that similar growth coming into Q4, and we've established a synergy between the data analytics group and what we're doing on the field delivery and chemistry. Traditionally, our data analytics group had been utilized in the midstream and downstream, where we could see the quality of produced gas and hydrocarbons. We also could help monitor transmix applications or monitor vapor pressures in refineries. We've since moved these applications up closer to the wellhead to where we create a significant amount of synergy between our in-field chemistry delivery and what we do at monitoring field gas operations for the running of hydraulic fracturing fleets. Now, what's exciting about this is you take the fact that there's a lot of stranded field gas in operations, the fact that we want to run these Tier 4 and electric fleets off this field gas production, which would cut down on the amount of diesel consumption. We've since applied these in multiple frac locations across the United States, working with our partner ProFrac, and what we see is a 60 or 70% reduction in diesel consumption on these Tier 4 fleets. When you look at that overall impact on the hydraulic fracturing fleet in the United States and opportunities there that open up in anywhere we're seeing compressed natural gas and monitoring field quality and our ability to replace gas chromatographs, this is a great opportunity to create synergy between our chemistry and field deployment and what we're seeing in terms of the operations with data analytics. Now, as a result of our rapid growth, we're continuing to reach the benefits of this larger scale and scope. We're seeing our ability to deliver manufactured goods across the world improve and helps to minimize the potential risk that we have on the supply chain. And this is helping us reduce costs, create efficiency, create more partnerships across the globe. And what does that do? That allows us to accelerate our ability to get towards free cash flow. And this is a very exciting time for Flotek as we're making this transition. We're seeing this market share gain. The business is improving. And again, what's more important is we're at the forefront of driving a sustainable transition to responsible oil and gas and energy production. And we're doing that based on the fact that we are using chemistry as the fundamental driver and the fundamental platform of how we do this. In addition to what we're seeing on the rapid growth and these economies of scale, we're continuing to monitor our balance sheet and that we had no debt. We had one small PPP loan in 2022 that's since been forgiven. And that's, again, helping us, when you look at the significance of this ramp and us being able to do this without any debt or any ABLs or revolvers, it's been quite significant, which is, again, an attribute to the lean, efficient way that we operate our order to cash process and the relationships that we have with our customers to continue to drive operational efficiency. And what's more important, lastly, we like to kind of talk about this as a capital-light business model, in that we've done this without spending any money in the operational part. We have core facilities that are around the United States in Rayson, Louisiana, Marlow, Oklahoma, the Midland Basin, and we have significant manufacturing capacity. And more importantly, we can continue to grow at the current rate that we're on without having to add any what I would call substantial infrastructure CapEx. And so from there, we're seeing higher utilization rates. And this, again, is impacting our ability to drive down costs and have a more efficient business going forward. Now, it also, when we look at capital utilization rate, that makes us, again, better in what we're doing. And the thing that we're leading into now is our ability to improve our logistics in terms of having our own trucking, having our own delivery models with our ISOs telemetry, and helps tie in the data analytics to the field delivery components, driving another substantial, I would say, evolutionary step in the way we'll make our business more efficient, real-time data access, and reduce MPT. Now, the final thing that I wanted to comment on in this significant ramp is the fact we've been able to execute this significant market share, revenue growth, and volume change without having any MPT related to our field delivery manufacturing, but more importantly, no spills and no lost time incidences that have occurred in the field. And when you look at what we have in the field services, or oil field services part of the industry, that's a big focus for us, and the table stakes of being a significant player going forward is us being able to do that. Now, looking at the final components, I guess, and what we would say would be an overview, is that we've created a full business model here now that can weather the cycle of uncertainty of revenue, and that our revolutionary ProFrac contract provides us a $2.2 billion backlog of revenue over the next 10 years. We're continuing to cost effectively manage this growth and this business while having a strong balance sheet. And we look at how these things are starting to come together for 2023. And we do feel that this is going to be an excellent year, excellent timing for investors, because as you look at the focus on environmental leadership, we look at ESG, we look at growth, we look at being able to generate free cash flow. It's a great thing that all plays towards Flotek's strengths. And again, we're turning out things in terms of our final sustainability report for 2022. And although, there's lots of focuses on ESG, truly Flotek represents a vehicle that allows what I would say the handshake between total cost of ownership, and that we help deliver operational AFE costs, but we also minimize the environmental costs to operate, which basically creates a social license to operate for sustainable energy production here in the United States, and also our approach to the global business as a whole, where we're seeing significant impacts in the Middle East as well as Europe. So it's an exciting point for us. We'll continue to stay focused on our profitability, and that we're driving the best in class SGA performance, and looking forward to what we'll deliver in our upcoming conference call here, showing our Q4 numbers and where we're going to be going into 2023. And with that, we'll open this thing up for questions and discussions, and just really excited to be here today.
Great job. I heard Oklahoma, so I'm out of Oklahoma. Happy to have you up here in my state. All right. So let's talk a little bit about going into a little bit more details on the ramp up of the ProFrac contract. So how have we been trending towards the 30 fleet target?
That's a great question, and one that from our investment community draws a lot of attention. As we mentioned, the ProFrac contract itself is a 10-year take-or-pay contract that is not exclusive. However, it requires that we have reached a minimum of 30 fleets throughout the 10 years. And I'm proud to say that as we exited December this year, we were sitting at anywhere from 21 to 23 fleets, depending on pad-to-pad movements. And we've continued to accelerate that in January. So we averaged around 21 fleets in December. So we're definitely close to the 65-70% of the way of the ramp up, and on track with what we have been talking to the investment community doing. And, really excited about this, because even, a lot of people have seen these disruptions that went on in operations, but in Q4. But, for us, we've continued to see the growth. We've seen quarter improvement, and really excited about where we're going with ProFrac.
Wonderful. So ProFrac has been active in M&A. So how does this impact your contract with them?
It's actually, we haven't seen any negative impacts on the M&A. We were actually pretty excited about it. In terms of the way our partnership works with ProFrac, it was to help design a integrated solution where they are highly focused on efficient hydraulic fracturing fleets. When you look at them bringing market leadership of the electric fracturing fleets, also with their Tier 4 dual fuel units. The acquisitions, a lot of the times that they're making, are acquiring more fleets. And as I mentioned, although our contract for ProFrac requires a minimum of 30 fleets, it's not limited by the total number of fleets. So we look at that as potential upside to what we're going to see as we continue to grow our working relationship and market pursuit with ProFrac. And they've been a great partner so far for us. And we really have been able to create a lot of synergy between the two in terms of we handle the testing, the technology delivery on the chemistry side, and they help us and guidance on getting more efficient on the actual field delivery and service aspect. And we both are focused on safety.
And Ryan, can you talk a little bit about the growth in the chemistry business separate from ProFrac?
You know, that's a great question, and one that I'm really excited about is oftentimes because of the revolutionary nature of the ProFrac contract and how that's really provided a lot of acceleration in our growth, we're just as excited about the core transactional business. When you look at our ability to grow there, we've seen substantial market share growth just in that business alone. And when you couple that with what we've seen in JP3, both of them in a combination have outpaced the frac industry market growth quarter on quarter for the last 5 quarters. And so we're really excited about that. We're going to continue to see the evolution of those businesses in 2023 as well. And the big thing for us in that aspect is we really represent that part of full service delivery of focusing on the estimated ultimate return in the reservoir. And the majority of those businesses where those wells that we're working there are outperforming the basins in comparison to the rest of the wells that are drilled there. And that's the big focus for that business, is that full cycle delivery on our surfactant technologies and intellectual property there.
So with all that said, where are you from a market share perspective for chemistry, and where do you expect that to trend?
So when we look at our stimulation business, our hydraulic fracturing chemistry business, it exited the year in December 2021 at right around 1% market share in terms of how much chemistry we were delivering to the active fleets. As we exited December, we were almost at 11% market share. And so you can see in a 12-month period, that's significant growth for us. And we're continuing to see that grow already in Q1 of 2023.
Can you also help us understand a little bit more the outlook for your JP3 business?
Yeah, you know, it's really exciting. And it's one of those things to where we look at the synergy created between what we do is chemistry is the fundamental base of Flotek. And JP3 is a phenomenal opportunity here in that we have a differentiating near infrared sensoring technology that is small, mobile, very robust. It's field proven. We've been utilizing it in field locations for over a decade with minimal maintenance. We've now moved these into operations upstream and looking at hydraulic fracturing, as well as even power generation using field gas on drilling rig units. And what we're excited about this business is it's always been a great performer in the mid to downstream. And what we're looking at is capital installations at refineries. But what's great in that the synergy created between it and chemistry is now is as we get closer to the wellhead, we're actually able to start looking at the quality of production, how efficient the fleets are running. We can actually start, you can even do a back calculation on the reduction of diesel where they're generating carbon credits for the MP operators by the hydraulic fracturing fleets that are running more efficiently. And just you think about where we're going to be at the strength of the business at that 285 to 300 fleets or more in 2023, in measuring field gas, you also take into consideration that anywhere where we're using compressed natural gas, whether it's running other diesel units and other industries, et cetera, JP3 is a phenomenal tool to be able to make sure we've got efficient operation there. And so, you know, those guys in our division there in data analytics are doing a phenomenal job at pursuing that business. And we really believe we've turned the curve and the ability to where we can hand in hand show how the two divisions between chemistry and data analytics work together. And right now, you know, our biggest thing is meeting the demands on getting the units out, because there's consistent, as you know, there's supply chain stress that we've seen. And right now we're meeting and exceeding. And we're really excited about the growth of JP3 in 2023.
Great. David White, in terms of the path to profitability, David wants to know, how do you get there under the current terms of the ProFrac contract? And how many frac crews would it take?
So that's another great question, and though at times because of us being publicly traded, I'm kind of limited on the exact specifications on our margins. But what I will say is that as we're ramping up, there's a significant amount of activity going on. So we're seeing mobilization costs, initial project setups, the initial movements of inventory, and so the first couple of quarters that we've seen are carrying burdens of just ramp inefficiency, which you'd normally see in this type of scale up where you go from one fleet to 20 plus fleets across the United States. Now that we have gotten a big majority, I would say 65+%, 70% of the fleets up and running, we're starting to see significant, what I would look at, economies of scale start to come into impact. And if you look at those in terms of what our turn rates of inventory and how those cost efficiencies start to come into play, we're really going to start to see the improvement in the margins when you roll into the first quarter of 23 and beyond. We're getting much leaner at our operational delivery in terms of the types of tanks we use, the trucking routes that we use, where we're blending and buying chemistry, and we're continuing to see those operational efficiencies come in play, which are hard to do when you're ramping up. You're picking up one or two fleets a month, as we're growing, and so we're really excited about it. And I do think that we're going to see much stronger margins come into play in 2023, which is what we've been expecting. And you couple that with the growth of the data analytics group, and also which is a lot of data as a service, and what we're seeing on the transactional business, which traditionally runs more of our high-end technology, we're confident in where the margins are going to continue to improve in 23, which is going to drive our ability to get to free cash flow.
Wonderful. Question from Eric Swiegold. Eric says a number of service companies have been raising prices to their customers. Is there an opportunity for FTX to raise its chemicals pricing?
That's another great question, and I think for us the short answer to that is yes. And I believe that there's a component of we're very cognizant of the pulse of the market on what the market price and what the market price for base services are. And I feel like, our customers are starting to realize, and we're starting to, as a company, realize the value that we bring to operations, not only from a service quality, service delivery, supply chain efficiency, but also just the technological and improved reservoir recovery. And so that's going to allow us pricing power going into 2023.
And Matthew Johnson wants to know how you are improving your gross margins. Even with 2 quarters of over 100% revenue growth, gross margins have remained negative.
So there's a couple of components to take into that. The biggest stuff for us is that, number one, we were burdened with quite a bit of logistical and mobilization costs in the first couple of quarters. We had to mobilize and move storage tanks, field delivery trucks, the initial move of the raw materials themselves, inefficiencies, and just the overall components there that we are now eradicating down. You look at freight as a percentage of revenue is significantly decreasing. And also, we're starting to see finally the impacts of economies of scale on our initial pricing come into play, which are going to drive substantial improvements in gross margin. Because when you look at the cost of our business, raw material costs and logistics are the big component. We've always run a very lean operation from the direct cost base in terms of people and facilities. And so for us, it's a matter of translating the raw material costs and freight and logistics efficiencies that will really start to drive the gross margin improvement. That along with some pricing power.
And another question from Matthew. How is the company handling the net working capital issues with this growth? It says they've still not seen any update on establishing an ABL facility.
So we are right now, we've been getting great. Honestly, a lot of the stuff is the working relationship within our payment terms with the majority of our customers are actually inside the payment terms of where we pay on our suppliers. That's definitely helped us manage our cash flow in this ramp. And then also, we've got a couple of customers that pay really well that drive that. We have activity. Now, in terms of the ABL, we are actively looking at facilities in terms of we feel like we're a good option for that now. We had evaluated some of those in a prior quarters, and we didn't feel we were getting the best terms for that, and we're able to survive on how we were doing on cash. And and just due to the efficiency of the operations. But we are evaluating options for an ABL and revolver type funding in 2023.
Great. Amy Romero says when she saw you were coming on the Emerging Growth Conference, she took a look at the company, noticed that at least one insider has been increasing their position. So given the price of the stock, does the company have any intention of doing a stock buyback?
I would, at this point in time, I don't really have the comments on that. I might defer that to our investor relations with Bernie and see where that is. I'll just hold on my comments on that right now.
Okay. Jim Lambert wants to know, who are your competitors and how are you getting your customers? What is the growth plan, especially once you go cash flow positive?
I think, that's a great question. So we do quite a bit of, I would say, market analytics in terms of how we segment our customer, depending on how they buy, what types of chemistry it is. We've done a significant amount at growing our customer base and leveraging our abilities in the stimulation chemistry business. We are constantly evolving where we sell chemistry, and that we're moving into some of the cementing additives, as well as drilling fluid additives, as well as production chemicals. For us, when we look at this on the core chemistries that we buy, our technologies apply in a lot of those other areas. So we're picking up new customers, what I could consider to be consistent recurring customers in that manner. Also, when you look at just, we'll pick up an additional 10 fleets from ProFrac in comparison of 23 to 22. It'll drive. And, when you look at our transactional business in JP3, we have very specific customers that we have targets and strategic plans on how to go out and bid as part of the bidding process to pick up additional work in the stimulation business. And I'm also really excited about some of the things that we're doing for growth that diversify our revenue stack a bit in our professional chemistries. We are, as a true fundamental chemistry company, we're looking at areas we're delivering or getting revenue from the geothermal aspect of the business. We're doing solar panel coatings. We're doing some things in the agricultural business. So quite a few things that run off of our base chemistry technologies and intellectual property portfolio that aren't just related to the energy side. So quite a few things for us to pick up a customer base on there.
Great. Veron Wong asks, is or does Flotek buy its own trucking to transport chemicals?
Yeah, that's a great question. And for us, in the initial parts is we've relied a lot on third-party relationships that we've done a majority of our trucking through a multitude of contracts. And we break up our trucking in terms of inbound raw materials versus outbound to field service locations. And then we consider last mile, which is the actual delivery to the well site or frac location. And we are extensively evaluating different things where there's capital purchases or capital lease to bring in some additional trucking. We have to monitor that with how the cycle looks and activity to where we don't get, one of our deals is capital discipline, but we are looking at different ways to create efficiency on a lease versus buy protocol for some trucking and or some of the ISO tanks and field delivery tanks that we use.
Great. Chris A asks, what are the margins on your data business? And can you explain that model?
I can't, I'm not really going to comment on the exact margins on there. I will tell you this, that the data business is obviously like any high-tech business. The margins are much stronger in comparison dollar to dollar versus our chemistry business. And, the data business revenue and margin streams come from two ways, is that some of the revenue is capital purchases and that people buy the actual equipment and install it in a manufacturing facility. And we do a data as a service and monitoring and maintenance. And then when you move into the upstream environment, most of the revenue is a service revenue in that we have a monthly charge to have the actual unit and monitoring service on location. So it's kind of it's a diverse mix, but we are slowly transitioning to the growth of a lot of that as data as a service models, and that's really very accretive in terms of margin percentage in comparison to just pure chemical sales.
Great. Well, Ryan, this has been a fantastic presentation and also a great Q&A. We've got more questions for you, but we are out of time. So we'll send you these questions directly so you can answer them on your own time. And we really thank you for being here on the Emerging Growth Conference, and good luck with everything.
Okay. Thank you so much.
All right, everyone, stay with us. We'll be right back with our next presentation.